But why, if markets are efficient, then why does Buffett say that you should invest in an index fund?
Oh, but okay, and I think that that's a good point. To do well, to be on the right side of the trade, you have to be a professional investor.
Hello, fellow intelligent investors. My name is René Salman, and in this video I want to discuss whether private investors, so retail investors, have a chance of performing better than professional institutional investors. And the debate of whether an individual investor can beat the market is probably as old as the stock market itself. And quite recently, the two investing heavyweights, Warren Buffett and Bruce Greenwald, they shared what they think about this subject and whether they believe ordinary investors can do well when it comes to actively picking stocks. And interestingly, the two seem to have two opposing views on this matter. So without further ado, let's have a look at their views on this subject.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Salman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, obviously we all invest with the hope that one day we will reach financial independence and will have enough money to live off our investments. And the higher your investment returns, the quicker you will get there. That's just how compound interest works. Over the course of the last decades, an investment in an S&P 500 index fund returned roughly 10% annually, which is certainly quite an impressive result. But if you were able to achieve 12% annually, that would make a major difference. Let's just assume you invest $1,000 a month for 30 years. If you generate an annual return of 10%, you will end up with $2.2 million after 30 years. If on the other hand you are able to beat that return and achieve 12% per year, you will get to 2.2 million 4 years sooner. And after 30 years, you'd end up with roughly $3.5 million. And let's just say you were able to achieve 15% annually. Well, then you would be worth almost $7 million after 30 years. So I think these figures certainly illustrate why quite a lot of people attempt to beat the market. And all of this sounds good in theory, of course, but the question is certainly whether a private investor can actually beat the market and can have what it takes to perform better than big institutions that invest millions or even billions of dollars in the market. Well, as I said in the introduction to this video, quite recently, legendary investor Bruce Greenwald, who used to be a professor at Columbia University, and he actually also taught a very popular course on value investing, well, he appeared on Yahoo Finance and gave an interview. And during that interview, he actually claimed that you must be a professional investor to do well when it comes to picking stocks. So let's just hear what he had to say.
But why, if markets are efficient, then why does Buffett say that you should invest in an index fund?
Oh, but okay, and I think that that's a good point. To do well, to be on the right side of the trade, you have to be a professional investor. So I'll say something that ironically should absolutely dominate the investment world and doesn't, which is if I'm going to be on the right side of the transaction more often than not, I probably ought to be a specialist. So you don't have internal medicine guys doing orthopedic surgery. Medicine law is highly specialized. And if I've spent my whole life trading onshore, South Texas Gulf Coast oil leases, and that's all I do, and you fly in from Germany and buy an oil lease from me, who do you think made money in that transaction?
Right.
And the idea of specialization plays no role in academic finance, Adam Smith notwithstanding.
But does this suggest that for ordinary investors, then they should pretty much stick to index funds, maybe unless you're in a field like, say, you're a dentist and you see that this new product is going gangbusters and people don't seem to realize it, and then you buy that stock?
That is a very good way to put it. The problem, of course, with that is once the dentist does that in dentistry, he decides he's a market genius and he decides he can do it every place. No, you have to be incredibly disciplined about why you're the person who's going to be on the right side of the trade. And most part-time investors are not equipped to do that. But if you just buy the index, you can't be on the wrong side of the trade.
Right.
And it prevents you from over-investing in the glamour stocks. And that's the sense in which Buffett is absolutely right. You have to be specialized. You have to understand by industry and even by geography these days.
Right.
You have to be, because you're an industry specialist, good at judging managements and knowing if you're going to intervene with management, because activism is increasingly important, where you're going to find a good alternative management if the management doesn't go along with it. So you need a lot of detailed knowledge. You need a superior valuation methodology, because you have to know what you're buying. And a DCF methodology is almost worthless.
All right. Now, when I first watched that video clip, I felt a little offended, to be honest. How can he dare to say that to do well in investing, you have to be a professional, that there is no alternative? After all, personally, I'm a private investor and I'm working in a non-finance related job, and I have done quite well in my first few years of actively investing in stocks. But after thinking about it for a while and what he said, I think I partly agree with Greenwald. More specifically, what I agree with are two aspects. Firstly, the average private investor will not beat the market. Let me just show you a graph here. This is a graph that shows what returns for 30 million investors would look like in a market with an average return of 9%, assuming the returns had a normal distribution. Half the investors would beat the market, half the investors would not. A smaller number of investors would do very well, and an equal number would do quite horribly. But this is certainly not how the market returns are distributed among investors, but to be fair, among both private but also professional investors. The actual distribution probably looks more like this. This graph here also shows 30 million investors and an average return of 9%, but now with a so-called power law distribution. Clearly, based on such a distribution, only a very small number of investors can consistently beat the market, and the vast majority, 95% or even more, will underperform the market. Now the big question is certainly, who are these winners? And this is where I probably disagree with Greenwald. I think the winners are not only institutional investors. Of course, a few of the winners are professionally managed funds, but not all fund managers beat the market. In fact, in the investing world, I think it is common knowledge that actively managed investment funds often underperform benchmark indices like the S&P 500. According to an analysis of the S&P 500 SPIVA report, across all domestic actively managed equity funds, the vast majority underperformed their respective benchmarks over a period of 20 years. And by the way, the same can be said about international equity funds. But I will get to this later in the video once we listen or have listened to Buffett himself. Now, the second point I wanted to make here is that Greenwald is certainly right that professional investors enjoy some significant advantages over private investors. Let me give you a few examples here. As a professional, you get to talk to management. You get access to highly trained analysts who maybe work in your team. And you also have access to third-party research tools that are sometimes worth thousands of dollars and that a private investor simply cannot afford. And of course, you also have access to a network of other professional investors who are often specialized in their respective field. But despite institutional investors having access to all of these resources, most of them still cannot beat the market, as we have just shown. And I would argue that this is because professional investors also have some disadvantages, which can explain why so many of the actively managed funds actually underperform quite popular benchmarks, and why some private investors, the ones who know what they are doing, who have a system in place and who do not diverge from that system, why these private investors can do better than professional investors despite not having access to these resources. And Warren Buffett seems to disagree with Bruce Greenwald too. So let's kick things off by listening to Buffett himself and what he had to say during the 2017 Berkshire Hathaway shareholder meeting.
It's an interesting question. I mean, if you hire an obstetrician assuming you need one, they're going to do a better job of delivering the baby than, if the spouse comes in to do it, or if they just pick somebody up off the street. And if you go to a dentist, if you hire a plumber, in all the professions, there is value added by the professionals as a group compared to doing it yourself or just randomly picking laymen. In the investment world, it isn't true. I mean, the active group, the people that are professionals in aggregate, cannot do better than the aggregate of the people who just sit tight. And if you say, well, in the active group, there's some person that's terrific, I will agree with you. But the passive people can't all pick that person, and they don't know how to identify them.
So there you have it. Buffett seems to disagree with Greenwald. He just said that the group of active managers as a whole are not, or actually cannot do better than those investors who just sit still and do nothing. And admittedly, Buffett is probably referring to passive index investors here. One explanation of the poor performance of actively managed funds are certainly the fees that investors have to pay professional fund managers for managing their money. But there are other drawbacks of managing money professionally. And I could probably do a whole video about the inappropriate incentive structures that make it so hard for professional fund managers to outperform their benchmarks. And that make it hard for them to take a long-term view. But let me just mention a few ways in which professional investors are disadvantaged. Firstly, professional fund managers face career risks if they underperform their benchmark for a few months or a year or two. And as a result, they will have to take a shorter-term view than you as a private investor can take. Professionals as a group would rather copy some of the purchases or sales some of their peers make or made than take a contrarian bet that can deliver long-term or big long-term returns, but that might also come with a significant amount of career risk if they are wrong in their contrarian bet. The consequence of underperforming in the short term can be quite significant for them. They might simply lose their job. Imagine what you would do in their shoes. Imagine what you would do if you had to earn money to provide for your family. I would certainly rather copy my peers than take a contrarian bet. And as a result of these flawed incentives, professionals will often own many more holdings than what they themselves would consider optimal. Because for them, short-term volatility represents a real risk, which it doesn't for us as private investors. And the more holdings you have in your portfolio, the harder it gets to outperform the market. And in addition, fund managers also have to be short-term focused because of their clients, private investors that are investing in their funds, because they will often liquidate their investments if the fund underperforms a benchmark in the short term. And as a result, fund managers frequently have to raise cash and sell positions if their clients want to get money. And as a result of these constant inflows and outflows of money, professional investors have to make much more buying and selling decisions than the typical private investor. So, as a private investor, you enjoy a real edge here. You can view risk the way you are supposed to view it or look at it, not as career risk, but as the risk of permanent loss of capital. That's my definition of risk. And I've used the term time arbitrage in many of my previous videos. Basically, time arbitrage refers to an opportunity that is created when a stock misses its mark and is sold based on a short-term outlook, but the long-term prospects are still intact. Or maybe the current stock price might simply not reflect the long-term prospects of the company because the market is overly focused on the next few quarters, or as I said, maybe the next year or two. So, unlike professionals, as a private investor, you don't have any restrictions. First and foremost, you can invest for the long term, and you don't owe anyone any explanation for a short-term underperformance. All you care about is your long-term performance and ideally your long-term outperformance, which is measured by years or decades and not months or the performance within a quarter. And in addition, you can invest in whatever industry you want. You can invest in companies of different sizes. You can invest internationally. And you don't have to trim positions so the size of the positions, if they exceed a certain size, a certain portfolio weight. Personally, I'm a big fan of Brian Feroldi, who is a big proponent of the mantra of letting your winners run. Because generally only very few stocks account for all the long-term market returns, so you absolutely need to let your winners run. And I think Peter Lynch once said you don't want to be watering the weeds and cutting the flowers. I think that metaphor is quite a nice illustration of this concept. And not only can you size your positions the way you want them to, but more generally you can also run a much more concentrated portfolio than most professional fund managers, and you can be concentrated in your best ideas. And lastly, I think you can sell and buy individual positions without affecting the market. And this is something especially the very big fund managers cannot do, because if they invest tens or hundreds of millions of dollars, they will inevitably move the stock price of the underlying security. And this is also that Charlie Munger addressed during the same Berkshire Hathaway meeting that I have already shown you previously. Fund managers eventually suffer from so-called size problems because the universe of stocks they can invest in simply gets smaller. Let's listen to him.
It's even worse than that. The expert who's really good, when he gets more and more money in, he suffers just terrible performance problems.
Yeah.
And so you'll find the person who has a long career at 2 and 20, and if you analyze it, net all the people have lost money because some of the early people have had a good record, but more money come in later and they lose it. So the investing world is it's a morass of wrong incentives, crazy reporting, and I'd say a fair amount of delusion.
Yeah, if you ask me whether those 12 people I picked would do better than the S&P working with $100 billion, I would answer that probably none of them would. I mean, that would not be their perspective performance. But when I was talking of them, or referencing them, and when they actually worked in practice, they dealt generally with pretty moderate sums. And as the sums grew, their relative advantage diminished. I mean, it's so obvious from history. The example I used in the report, I mean, the guy who made the bet with me, and incidentally, all kinds of people didn't make the bet with me because they knew better than to make the bet with me. There were hundreds, at least a couple hundred underlying hedge funds. These guys were incented to do well. The fund-to-fund manager was incented to pick the best ones they could pick. The guy who made the bet with me was incented to pick the best fund-to-funds, and tons of money. And just with those 5 funds, a lot of money went to pay managers for what was subnormal performance over a long period of time. And it can't be anything but that. And it's an interesting profession when you have tens of thousands or hundreds of thousands of people who are compensated based on selling something that in aggregate can't be true, superior performance. So, but it'll continue, and the best salespeople will tend to attract the most money, and because it's such a big game, people will make huge sums of money, far beyond what they're going to make in medicine or you name it. I mean, repairing the country's infrastructure. I mean, the big money huge money is in selling people the idea that you can do something magical for them. And if you have...
Well, what Buffett said towards the end of that video has to make you think of ARK Invest, right? But just wanted to mention that here, but I don't want to make it the point of this video. So if we consider what Greenwald and Buffett said about professional fund managers, I think there is some middle ground actually between their two positions. Remember the two graphs that I showed you earlier? I think the actual distribution of performance probably looks more like the power law distribution, both for professional fund managers, but also for private investors. A few of the professional investors will outperform the market, the Seth Klarman, Pat Dorseys, Guy Spears and Mohnish Pabrais of the world. And obviously, hundreds of lesser known, smaller fund managers will also do very well. But then there are also some private investors, amateurs, that can also beat the market. But the vast majority of both groups will not do better than a low-cost index fund. So in a way, I agree with Greenwald. The average investor may not have a very good chance of beating the market, because picking stocks successfully absolutely requires professional skills and specialized knowledge. You cannot expect to pick stocks successfully without having spent a ton of time becoming educated and learning from the investment grades. And most investors are probably not equipped with the discipline to fully understand the details of each trade they make. And most investors, private investors, probably don't have a system in place. And maybe most importantly, they themselves are probably their worst enemies. So they might be selling stocks when there's a negative sentiment, so exactly the worst possible time, and buy stocks when people are greedy. And impatient investors who let short-term volatility guide their decisions, who keep switching in and out of positions, they will do very poorly, that's for sure. So here Buffett and Greenwald certainly agree. The vast majority of people will be better off simply buying or investing in a low-cost index fund and then just leaving the money alone for many years or even better, decades. And I think Buffett and Greenwald would agree that unless you put a lot of time and energy into the art of stock picking, you absolutely cannot beat the market. Remember that everyone else on the planet is trying to do exactly the same thing. And some of them, some of these people who do it actually do it for a living. They are professionals. But you do not only have to put a lot of time and energy into it. No, simultaneously. And I think this is what makes investing so hard and paradoxical at times. Now, simultaneously, you often have to sit there and do nothing for a long period of time. You basically learn about hundreds of businesses and only end up investing in very few of these investment ideas. So what is the bottom line here? I think as a private investor, you have to acknowledge that it is hard, or that investing is hard, and that you might not beat the market. In a way, this brings me to my last point that I wanted to bring up. I think there is more to investing than maximizing your returns. For some people, learning about businesses is just a passion, and they genuinely enjoy learning about various industries, about new inventions, about the internal dynamics of businesses that we all know, like for example, the Spotifys, Facebooks, or Apples of the world. And I love it when people have found a passion, and who cares if they beat the market or not. Overall, I think you want to stay humble and acknowledge that there is no way of knowing whether you can beat the market over the next 10 years. Acknowledge that there is a good chance that you do not have the superior analytical skills needed to beat the market. And maybe more importantly, that you do not have the right temperament to do well on your own. I think acknowledging this can actually be quite freeing, and maybe at the end of the day, acknowledging this might even make you a better investor. And with that, I think I'm going to wrap it up here. As always, may your finances and investments prosper. Good luck.